Hi all. Today we will see about the first topic in the subject financial management, introduction to financial management. Let us all learn about the term finance. The finance means it is the art and the science of managing money. It is considered as the lifeblood of any concern, whether it is a business enterprise or manufacturing concern or a merchandising activity. It can also be called as a provision of money at the time it is wanted. It has also got another term called as business finance, an important term which can broadly be defined as the activity concerned with the planning, raising, controlling, and administering the funds that is used in the business. So, the concept of finance includes two important topics, two important areas that is called as financial services and financial management. As we all know, the financial services that includes any kind of services that is rendered by any financial organization like a banking sector or anything that involves in the monetary terms. But whereas this financial management involves in planning and administering the finance in an organization. That organization may be a company or a merchandising activity or any sort of it. Now we will understand the definition of financial management. According to Archer and Ambrosio, financial management is application of the planning and control functions to the finance function. That is what they mean, the application knowledge of the finance part. James C. Van Home in the year 1972 has also defined the financial management as concerned with acquisition, financing, and management of assets with some overall goals in the mind. Now, the financial management includes financial planning, raising of financial resources, management of financial resources, and control of financial resources. This is what we understood from that definition. That is, planning should be there, raising of fund, management of fund, and controlling of fund. Thus, it deals with the procurement and utilization of funds and in an efficient manner. See, these are the key words to understand the term financial management meaning. That is procurement, that is raising of funds, and the utilization of funds in an efficient manner is the exact understanding of the financial management. Now, there are two approaches to the financial management. One is the traditional approach and another one is the modern approach. So, what are the aspects of the traditional approach? During the traditional period, the financial management means only the raising and administering of funds needed by the corporate enterprises. That is, mainly they arrange the funds from the financial institutions like banks and other financial sectors, and the arrangement of funds from financial instruments like shares, bonds, etc. But it has got its own limitations. What are those limitations? They concentrate only on the procurement of fund. They neglect the internal decision making and the day-to-day financial problems of the firm, and they do not involve in the efficient manner utilization, and they does not pay any attention to the working capital part of the financial management, and there is no consideration between the financial mix and the cost of capital. Now, to eradicate the limitations of the traditional approach, the modern approach came into existence, and this modern approach is concerned both with the acquisition of funds as well as the efficient utilization of finance. The modern approach covers financial planning, raising of funds, evaluation of investment proposals, allocation of funds, financial control, etc. The modern approach covers three broad decision areas like investment decision, financing decision, and dividend decision. That is what, once the fund is raised, the company has to decide in which area to invest and what are the financing areas and where it is highly required, and also the dividend earning sector also. Now, Let us understand the major objectives of financial management. They are broadly classified into two areas. One is the profit maximization approach, and second one is the wealth maximization approach. Yes, we understand that all the organization run behind the profit only. So obviously, for all organizations, profit maximization will be a default objective. Along with that, this financial management has got wealth maximization approach also. That is a new term actually. Now we will see what is a profit maximization approach. See, as a owner oriented concept, it refers to the amount and the share of the notional income which is paid to the owners of the business, that is those who supply the equity capital. So that is why this profit has been termed under two viewpoints. One is it is an owner oriented concept, that is every owner in the country, they run behind the term profit only. Why? Because they are the one who is contributing the equity capital to the organization. And second one is the profitability concept. It is an operational concept, that is it signifies the economic efficiency. And here this term profitability refers to a situation where the output exceeds the input naturally. So everybody will be working for that, wherever there is a percentage of input, naturally the percentage of input should be lesser than the percentage of output. Now, the term wealth maximization approach is also known as value maximization or the net present worth maximization approach. What does it mean actually? So it takes into consideration the time value of money. The wealth maximization approach can be more explicitly diffused in the following ways. That is, A is equal to A1 divided by 1 plus K to the power of 1 plus A2 divided by 1 plus K to the power of 2, and it goes on to the nth value. For A1 and A2 till AN, it streams the benefit that is expected. It goes on to the C, that is C is nothing but the cash outlay or output. K is the discounted ratio and W is the net present worth. That is, what is the value of money today invested after 10 years. Now, there are three sources of finance also. The sources of finance is classified according to the period, that is short-term fund, medium-term fund and long-term fund. Short-term fund is nothing but trade credit and the bank credit. Medium term is again a very minimum, that is more than 1 year but less than 2 years. And long term fund starts with like shares and debentures, which is having a period of more than 5 or 10 years. Now, here comes the finance manager. Now, we understood what is finance, what is financial management, what are its objectives, what are its approaches, and what are the sources of finance. Now, we need a manager, we need a person who will take care of all these activities that is going to be carried in an organization. So that is why we always tell about the 5 M's of management, that is money, mission, material, method, and we need always a man to manage all these factors. Now we will understand who is a finance manager. He is also known as the vice president of finance or the director of finance. He might be a member of the top management. He reports directly to the managing director or general manager in terms of finance. So he is always responsible for the performance of the finance function in an organization, and he is very closely associated with the formulation of policies. Why? Because he is the one who is going to define where the fund has to be allocated, where it has to be invested, where the finance has to be raised, all those factors. And he also gets into making the decisions for the firm. So thereby he is always concerned with the financial planning and control. So he plays a advisory role in all the matters whichever is involving in terms of finance in an organization. Now, what is the importance or significance of financial management? Yes, every organization has got it. This topic is very essential wherever the fund is included. So it attempts to use the funds in the most productive manner, that is optimizing the output from the given input of funds, and it focuses on effective utilization of most important resource in any activity, that is the money. It helps in ascertaining how the firm would perform in future. It also helps to complete the coordination between various functional areas such as marketing, production, etc. to achieve the organizational goals. Almost every decision in the business is taken in the light of its profitability. Savings are very possible only when the firm makes substantial profits and maximizes its wealth. So, effective financial management helps in promoting and mobilizing the individual and corporate savings. It also helps in profit planning, capital spending, measuring the cost, controlling the inventories, account receivables, etc. Thank you.